Hello and welcome to Gemcast, the podcast from Gemcorp Capital, where we explore emerging and private markets and all the topics at that intersection. Today I'm joined by Felipe Berliner, co-founder and head of structuring here at Gemcorp Capital. Welcome, Felipe.
Great to be here, Tom.
So today we're talking about niche or global in private credit. So we're going to explore what that means for private credit, the evolution of the asset class, and why investors need to be looking a little bit further afield. So before we get started getting into that topic, Felipe, do you want to just tell me a little bit about your background and how you got here at Gemcorp Capital?
Sure, of course. I started my career back in Brazil, right? I'm born in Rio, started my career as a lawyer working with M&A, project finance. Worked for a good 6 years there before moving to Europe, where I did an MBA in France. And after that, went to the investment bank route through Merrill Lynch, Goldman Sachs, always on the emerging market space, structuring fixed income, doing private credit transactions in the banks where I was working. Through many years, especially during Goldman days, have met like some of my colleagues that together in 2014, we decided to start this business as a firm completely dedicated to investing in private credit emerging markets at the same time where the whole private credit industry was very nascent, but mainly on the developed market space. So we decided to recreate what we were doing over our careers and over the time that we have worked together and create something that was truly dedicated to emerging markets private credit.
Awesome. So kind of super innovative at the time when the creation of Gemcorp over a decade ago. Awesome. So look, let's start with a simple question. Why are we discussing, global private credit going into EM and niche?
Well, you have to understand a little bit where is it coming from, right? The majority of the capital that has been raised to date for private credit has been in the US for the US. And this number that today adds to about $1.7 trillion have been dedicated to two main streams, which are portfolios that replicate bank balance sheets, so very diversified mid-market US companies, and others that LBO kind of funds, financing sponsors into transactions that you're seeing more and more often. What happens when you have an industry that has grown so much is that you start showing signs of maturity, right? And if you compare what we are seeing now in the private credit industry with the high yield market, you see a lot of similarities and this trend where private credit is getting a lot of similarities to the high yield industry. So the size of one versus the other, okay? High yield industry, $1.8 trillion, while the private credit industry in the US is about $1.7 trillion. The spread between the two of them have tightened over time, something that was very wide on the end when private credit was a nascent strategy has now tightened. So you don't have exactly the same kind of benefits that you'd had in the beginning of the private credit industry. But other than that, the newest trends that you see is secondaries. So when private credit, that the main difference, right, that you had with the high yield market was that one being liquid in bond format, while the other illiquid in portfolios of loans. Once you add the liquidity to the private credit, then the similarities with the high yield industry becomes even more accentuated.
Okay.
So we believe that one asset class is becoming too close to the other.
Okay.
To the extent that the correlation is too high.
Yep.
And if you're basically doubling up and trying to believe that just by adding some of the private credit, traditional private credit to your portfolio will generate all the diversification that you're looking for, that may not be the case. Right? And that's why we believe that from now on, we are going to see what's called, what at least we're calling private credit 2.0. Right? Once you have an industry that is reaching maturity, what you expect to see is segmentation. And segmentation going forward, we can see already strong signs of the big players in the US raising vast amount of capital to deploy into infrastructure Europe, which is the area that they're more comfortable with. Right? That's very similar characteristics of the US market, developed market, Western Europe as well. And infrastructure is a theme that resonates very well. But at the same time, you have other strategies that have been overlooked until now. And we believe a lot of traction will start happening for those, and I can point out a few. Emerging markets,
Okay.
right? Emerging markets, we're definitely starting to get inquiries that we didn't get before.
Yep.
So when we started this business 10 years ago, we had 2 mountains to climb. One of them was to explain why private credit,
Yep.
and the other was why emerging markets.
Yep.
Now private credit became so mainstream and very well adopted by the institutional allocators that you don't have to talk about it anymore. It's almost boring. While emerging markets, finally, it's seeing the light of day again, right? What happened to emerging market over the last few years? And we spent so much time with institutional allocators last year that asked me about the projects that we have invested, and they were very happy with how impactful they are in the emerging markets where we invest.
Yeah.
But when we get to the end of our presentation and I ask them back, so how is your allocation to emerging markets? I think 99% of them would still have half of it, i.e. the fixed income part, as an MB tracker or a long-only bond fund, and the other half of an MSCI EM tracker.
Okay.
Right? So we believe that this new trend where private credit is now very well adopted by the institutional allocators, combined with a better understanding that there is a way to play emerging markets, that you can have impactful investing, you can have proper returns, and the risks are really not what people expect to be.
Okay.
Right?
So,
when you look at the metrics.
So in short, then what you're saying is that the development in DM private credit has created more liquidity with the secondaries, and it's starting to behave much more like public credit. And that has some advantages, but obviously some in terms of the kind of the yields that you can expect, the risk premium is reduced because there's so much capital in the asset class.
Yeah, that's very much the case, Tom. And one of the pitfalls of that is, in order to continue with the same kind of return that private credit has generated over time, you start having leverage on leverage, which is a common topic as well these days. You have a lot of capital that has been raised for the strategies and big players fighting for the same deals, which means the power shifts from the lenders to the borrower. And then you start seeing cov-light transactions with high level of leverage on the deal level, plus some leverage at fund level to generate the double-digit returns, which were available between 2017 and 2022 or so. But these are the numbers that you can still see in this nascent class, which is the private credit emerging markets, that very much looks like what it was, investing in private credit some 5-7 years ago.
So in
in
that case, it's sort of back to the future to EM private credit then. In that sense, you're saying that if you look at EM private credit now, it's where developed markets were 5 or 10 years ago in terms of what's on offer to investors.
Correct. And look at the size of it, right? While the industry has been focused very much in domestic US and now in Western Europe, that's a very small percentage of the world population. So look at the macro tailwinds that you have behind emerging markets. You have population growth, you have GDP growth, you have a proper economic substance to drive growth in these economies, right? Mainly what we're looking for is on the performing credit, not so much on the distressed. And in order to bet on an economy or a company or an asset class growing, what you want is to look at those economies as a whole and see a future to it.
Okay.
Right?
But surely in today's world, appreciate those macro tailwinds, but we live in a volatile world, oil prices down somewhat, there's tariffs, trade wars. Intuitively, I'd be saying, is that a good time to invest in EM?
I believe so, yes. We definitely see this volatility. To some kind of products, it's actually beneficial. If you're looking into trade finance, for example, or commodity financing, you will need to see new flows. And the majority of the bank lines, they require established long-term performing lines in order for banks to fund them. When you see a major shift that require flexible capital, because you need to change your supply chain from one place to another very quickly, you need the flexible capital to be able to fill in this gap. We believe that private credit is the right kind of product to support traders, to support producers from different jurisdictions. And think about it as well. the majority of the issues that we're seeing now is a fight between the US and China and the spillover in all the economies around that.
Yeah.
Okay. But in a multipolar world, it may even be not very insightful, but the best thing you can do is to diversify. Don't put all your eggs in the same basket, right? So if you have all your exposure to this asset class into one jurisdiction, you may have a problem if suddenly that jurisdiction gets isolated, even if it's self-imposed or not.
Yeah.
So if you are diversified geographically and product-wise, you're better off if you do that. Now, does that affect emerging market? Sometimes positively, sometimes negatively, depending on the countries that you're operating, depending on the industries that you're focusing.
Yeah.
I'll give you an example, Tom, on infrastructure and risk perception. Okay. On infrastructure, all this discussion that we're having now on tariffs and deglobalization and reshoring of the economies.
Yeah.
This will require infrastructure,
domestic
infrastructure, not necessarily the usual global flows, global logistics, but the domestic infrastructure, industrial parks, roads and railways to inland, etc. And all that will require massive investments in infrastructure and the commodity that goes behind that, right? You cannot have investment in infrastructure without a commodity boom.
Yeah.
And I'm talking about traditional as well as digital infrastructure.
Yeah.
In the traditional one, you need cement, you need all the basic commodities, the metals, etc. While the digital one, you need the lithium or the rare earths, etc. that requires for data centers and microchips. But thinking about it more deeply, if I give you a few regions, and I'm going to ask you the question, what is your... you'll see. Between the United States, like North America, Western Europe, Middle East, Asia, Africa, and Latin America.
Yeah.
Where do you think you have the lowest possible default rate on infrastructure projects?
Well, I would assume it's going to be a developed market. It'll be, US or Europe, I would have thought.
Not really.
Okay.
Right? The lowest default rate that you can find in infrastructure projects is actually in the Middle East. And that is easily explained by the fact that a lot of the infrastructure projects are backed by the state where those infrastructure projects are built. So nothing really defaults. The governments would just step in and solve the problem, bail out if there is an issue. Now, the surprising one is what comes in second place. And the second place in lowest default rate is Sub-Saharan Africa. Okay. And whenever I discuss that with people, people look exactly like you, quite surprised.
Yeah.
Right?
Although I do work for Gemcorp, but so, maybe I won't be doing any more podcasts after
the
this.
Statistics is a very interesting one. And we spent some time trying to understand why is that the case. And we believe that there is what we call a positive selection bias, meaning there are a lot of projects that are very structural and very much needed, that are structural for the countries where this project have to be developed, and for everyone really, right? If it's a mining project, if an infrastructure project to extract it, etc. But there is not enough capital. So the little capital that is available for investment in infrastructure in Sub-Saharan Africa, they gravitate to the very best projects, those that have the best structuring around it, those that have DFIs and ECAs coverage, those that have the government support behind it. And they are very scrutinized, they're very well structured, and therefore they don't default when they get done. Now, if you go to the other end of the spectrum, you mentioned the US. The US is actually the region that has the highest default rate on infrastructure.
Definitely no more podcasts for me then.
No. And the reason is it's not a bad one. It's just that there's so much capital available that everything gets done. The good, the medium, and the bad projects, everything gets done, right? So there is some stigmas around the emerging markets that comes from people not really understanding, not looking at the data. But the lack of capital available for a lot of projects, and the fact that most of the projects are funded by equity, and you can select, right? There's not so much competition. So when you're going there, be a corporate, be an asset-backed transaction, be a sovereign, you don't have the same level of competition. You tend to be the single lender on a transaction, and these transactions are structured the same way that you would in a developed market. English law, single enforcement point of shore. Our deals there are other ways of doing that, but the way we operate is all hard currency based, right? We look for the exports. So these misconceptions need to be addressed.
Okay.
People need to understand that investing in emerging markets do not have the same amount of risk that one may perceive.
And it sounds like the way you're talking about it, it's a hugely diverse asset class. You're talking about infrastructure. Obviously, if you're thinking about developed markets, a lot of institutional investors might break that out of their private credit. So what can somebody expect to see inside an EM private credit portfolio?
That's a very good question. Because
I'm back on the podcast now.
Yeah. Inside the emerging markets, we ourselves define ourselves as a multi-strategy, multi-product inside the private credit emerging markets.
Yep.
And that would include utilities and infrastructure, long-dated, stable assets. That would include the trade finance and commodity finance, which are exactly the opposite. Super short-term, high yield, but highly collateralized transactions.
Okay, yep.
You have asset-backed deals. Okay, when we're talking about equipment financing or securitization of receivables, you would have the same kind of products, real estate, etc., that you would see in a developed market. But emerging markets has this tendency of being considered purely as an asset class, and it's not, right? It's a lot of different asset classes inside emerging markets, and being able to play these various asset classes inside the emerging markets is what makes it interesting.
Because it gives it a diversification benefit.
Correct.
Geographically and across sectors that benefits the investor.
Geographically, across sector, in a very vast region.
Okay, and what's the typical tenor? I mean, obviously we talked about infrastructure. If you're doing that in developed markets, it's kind of 10-year plus. Like, what does EM private credit look like in terms of tenor? Is it longer, shorter? What's an investor doing in that?
It depends the kind of projects you're doing. If you're talking about infrastructure, you also tend to have longer tenors, and I would say 8 to 12, not so much the 15, 20 that you would see in some super developed market projects. But at the same time, as we were discussing, trade finance, we're seeing more and more traction on this strategy, and this is by nature super short duration. We're talking 2 weeks to 6 months, revolving facilities, but very short duration, and that becomes very attractive for those investors that are looking for diversification and yield with asset collateral, okay, in order to deploy short-term liquidity. Right, because usually when you're talking private credit funds, you have longer lockups or close-ended funds, but the trade finance funds not necessarily like that.
Okay, so take everything you've said. Now, let's say I'm an institutional investor and I say, okay, I agree, the risk is misperceived. I can see the opportunity in the asset class. What's it going to give to my portfolio? So typical institutional investors probably got private equity, private credit. It's going to maybe have 30, 40% of its book, depending on what kind of institution it is in public markets as well. What does EM bring to the party for them? Why should they be allocating to that area?
Well, EM already brings by its own nature a diversification to developed markets, okay? But when we're talking about these various asset classes inside, you would have a diversification effect that is multiplied, right? Because we're not talking just, okay, I'm going to invest in Brazil, or I'm going to invest in Mexico or Poland.
Yep.
There's a vast array of emerging markets that can be invested, and they cross-hedge each other, right?
Okay.
When you're talking about, they don't move like everyone together as it used to be in the 80s, etc. A lot of the countries have solved their international debt positions, and they have very healthy economies domestically.
Yep.
So you are able to play each of them in a different way, with different weights, with different products. So it definitely adds up to a portfolio diversification. And I definitely think that having private credit with all its varieties, it's way better than having a long-only fund or an index tracker.
Okay, you've sold me. I believe in the opportunity set. I can see the evolution of the asset class, and I want to invest in EM private credit. What should I look for in a manager? What's the special sauce?
I believe that when you're looking for a manager to deploy your capital in emerging markets, private credit, you should look for someone that has that as the center of their strategy, not a shop that has recently added that. And just because private credit is so trendy at the moment and I need to have these various new lines of business, you have to look for those guys who live and breathe emerging markets for their whole life.
Yeah.
Because even though transactions are structured with the same way that you do in a developed market with the same level of care and structure around it. In the end, emerging markets, you require some expertise.
Yep.
So having people that come from the markets, that understand the markets, that are present on the ground, but most important, where it's part of their DNA, right? And not just something that was created recently to ride this wave of private credit. That's where you're going to get the real advantage and the full potential of emerging markets.
Okay, so born in Rio, a lifetime of experience in EM. Very good. I think on that note, Felipe, we will wrap it up. Thank you very much for sharing your pearls of wisdom with us today.
Thank you, Tom. It was a pleasure.
Now, for everybody, thank you for listening to Gemcast. We really appreciate your time. If you want to find out more about Gemcorp Capital, visit gemcorpcapital.com and get in touch with your sales representative. Thank you very much.